Hi, I'm Albert Azis-Clauson, the CEO of Tramlines and the host of our podcast, Track Record, where we talk to industry leaders, executives, business builders, investors, journalists, politicians, and economists about how our world is being reshaped, how investment is moving, how innovation is being done, and how AI is reshaping the world that we live in. Today, I'm going to be talking to Emily Turner, who is the CEO of HSBC Innovation Bank and the founder of City Ventures UK before. She has sat at the intersection of innovation, debt, financing, investment, venture capital, and today I'm going to be discussing with her what trends she's seeing and how she's seeing the industry shape and reshape around changes like AI. Emily, it's really good to have you on. I was thinking before this, we spent our time talking about trains, food, wine, AI, finance, and innovation. So I think we'll probably stick to the latter three of those topics for as much of the podcast as humanly possible. But thank you so much for coming on.
Thank you for having me, and I'm comfortable with all those topics.
Okay, great. I mean, if we can get something in about trains at some point, I think that would be quite exciting. But I wanted to start with a very broad question of what are you seeing in what changes are you seeing in venture, finance, innovation? And I'm being deliberately so broad because I think so much is changing and we'll find some things to narrow down on.
Yeah, so I mean, it's a great time to work in innovation and venture and as a builder. And I luckily, I'm very fortunate to sit sort of at the intersection of all three. If we just look at the UK for this year, but this is a trend that we see globally, investment is up nearly over 2x year over year going into this market. And AI is obviously a huge part of it, but that's not the only story. And so when I think about it, you have AI driving it, but you also have deep tech, and then you have a huge number of changes alongside just businesses across sectors. And to me, it's one part, a story of these huge deals that are grabbing all of the attention, but it's also the rest of the market that's also doing very, very well. And I think it's easy to miss one for the other.
And I think I definitely want to focus more on not the big deals. And I think when people talk about the market and what's going on, it's so easy to focus on massive, potentially overinflated bubble price, whatever it is. But actually, there's so much happening underneath. And we've already had conversations about how that affects services businesses and undervalued companies. And so hearing that there's so much more investment and that there is a broader story and we kind of remove that top end, what are a few things you're seeing in the mid and lower end of the market that you think are interesting?
Yeah, so let's just, if we ground ourselves first in some of the numbers.
Yeah.
So if we look at a market like the US, which is arguably the most advanced and mature, and certainly the largest scale in venture around the globe, over 90% of money goes to companies that raise over $100 million at a time.
Okay.
And whereas if you look here in the UK, which has historically been seen, some parts true, and I think some part more sort of lore, as a place where you couldn't raise large amounts of money. That's been sort of in the 50s and 60s and getting close to 70%. So we're moving in that direction in this country, and we're seeing large rounds. So in the first part of this year, 4 companies raised over $1 billion. We had a large number of 100 million plus deals, and those are all great things. So I think before moving to the other side of the market, we need to acknowledge that this is a market that's deepening, that's maturing, and you need to see the large deals to create that confidence.
To go back then, before we move on to the smaller deals and to go against what I just said, I had Lionel Barber on, and a big theme he has is around not writing off the UK, and that it's this kind of overplayed narrative that we are not innovating, that we are risk averse. And actually, I definitely don't see that in my world, but I'm generally operating at the lower end of the mid-market and looking at kind of, top end of 20 million revenue businesses that we're dealing with directly in terms of ownership. But he was really keen that he feels that innovation in the UK is reaching a height and a really exciting point. And those big deals are one piece of evidence that that's happening. But what do you think is allowed for that to happen, and what's building up to that?
Yeah, so I haven't listened to that podcast yet, but I will. But I share his view, right? I mean, this is a excellent market to start a company, to build a company, to scale a company. And for years, I think we've seen a value argument to that, so that you could get into companies here that maybe would be priced higher for instance, in the US. But ultimately, over time, from a returns perspective, investors here still saw the same, if not better returns than in other markets. And in the medium to long term, my view is that both investment as well as capital is totally globally mobile. And if we look at that, and if we take that hypothesis particularly around capital, we see that playing out. So there's more investment that comes into the UK from US investors than the UK puts in itself. And investors are very smart. They wouldn't be deploying money at scale in this market if they thought that there weren't great opportunities to make great returns that were on par, if not better, than what they're seeing elsewhere in the market.
I saw a really interesting trend in my conversations with investors, particularly at kind of up to Series A level. 5 years ago, any US major investor I would have spoken to would have either insisted upon or heavily pushed upon a flip and moving the top co into the US. I haven't had a single person ask me to do that in 2 years. And I hadn't really thought about it deeply, but it's definitely something that I've been very aware of because I'm expecting them to ask and then they do not. I'd be really interested to see if you have any thoughts on why.
It's an interesting one, and there's a lot of debate in the market right now, and I don't have a clear answer. I mean, I just spent the last 2 weeks in the States and asked a bunch of investors, as well as companies that have flipped or haven't flipped, this question. The reality is that you can attract foreign capital with a UK topco, and you can also attract US capital with a US topco. And so to me, I think it's more about sort of where does the founding team, where does the senior team want to drive the business, what's the go-to-market, and then particularly for certain industries. So for instance, if you were in an industry where you're selling mostly to the government, do you need to have a domestic, go-to-market? Those are the things that I think are really structural. Some of the other reasons why people have said, oh, I prefer this, I don't prefer that, it creates complexity around tax. Those things are all true, but they're very surmountable today in a way that they weren't before. So to me, both things work. And it's more about the company setting itself up for long-term success than short-term success.
You said that AI is obviously a trend. Although I had a conversation with a C-suite of a company that I will not name, where I asked them if they thought what they thought the problems with their company were. We were doing some enterprise consulting as part of a Tramlines program. And he said to me, near quote, there are cyclical changes and infrastructural changes. I'm pretty sure this is cyclical and we're just bobbing along at the bottom waiting to go back up. And I thought, that is a level of inertia that I have never experienced at the C-suite of a very large enterprise company. But excluding that view and assuming most of us agree that AI is a fairly infrastructural change that will have wide-reaching implications to business, the economy, financing, and more.
I'm in that category.
Cool. Okay, that's good to know. Good to clarify. Let's remove AI, and what are the other things then you're seeing that sit around that are part of that trend?
Yeah, so I think there's a few things that sit around that trend. So one is, I think that we're getting to a moment in a number of deep tech technologies where we're getting real proof points and real scalability. So this is everything from advancements in areas of things like fusion and battery technology and a number of different things that previously I would have said were around climate, but really just around energy to support things like AI, but much beyond. We're seeing that in space. We're seeing that certainly in biotech and drug discovery. So there's a number of technologies that I think, in addition to AI, are getting to a moment where you can go from the lab to commercialization. And that's super important. And importantly, back to the points before, for this country that has such a strong depth in research, what that could mean.
One of the trends that I've been really interested in is the idea of how big does a company need to be? How long does a company need to do things? And I was looking at some stuff in hardware. We have a company in the semiconductor space, and they saved circa 2 million quid and 8 months of development work around simulations using AI to do simulations on their behalf, which took a really kind of traditional hardware and turned it into a software accelerated business that needed fewer people. These are big companies. These are potentially big economically changing companies, i.e. having big implications. What do they look like different companies?
Well, I think so that's a great example that you just gave, because I think we've got two things happening at once. So one is you're seeing sort of the cycle time or sort of the product development amount of time, but importantly cost and effort go down. And so the ability to release a new product, to develop something that's very different has gone down. Your example is a great one. Combined with consumer behavior, we're seeing customers, both consumers and actually enterprise, adopt things at a much faster pace. We can look at this as sort of adoption of the mobile phone versus, say, ChatGPT. But if you put those two things together, it just means that we're in an ever accelerating rate of change where products can move more quickly and people are willing to try them more and more quickly. And those two things together, I think if you'll be constrained by whichever one is the slowest of those two, and we're seeing both of those increase pretty significantly.
So this, one of the things I spend a lot of time talking about with my team, with the companies that we work with our portfolio, is that technology is changing at an ever accelerating rate, as has always been true and is now getting terrifyingly fast. But the changes that are instantiated in business and in the economy are often more economic changes than they are technology changes, i.e., the technology facilitates a structural change that has other things. And the example that Glenn and my team always gives is that, the difference between Blockbuster and Netflix was not that Blockbuster had no internet and no website and no way of renting online. It was that Netflix used that technological change to take advantage of a new economic model that superseded the previous. And so, one of the views then is that if technology is so far ahead of our ability to change those economic models, what does that mean? So how are you seeing that side catch up with technology, or how are businesses going to transform based on their ability to transform because of technology in a world where it's expanding so quickly?
If I go back to my previous role, but something that sort of stuck with me for a while, is I've always thought about companies as having sort of 5 different tracks, and founders having 5 different areas of work that they have to pursue. So you've got product development, number 1, you've got customer development, number 2, you've got team development, number 3, you've got investor development, number 4, and business model development, number 5. And whichever one is going the slowest is the one that you should focus on. Right. And this is my simple view of the world. Yeah. But I can think about sort of many times of like whiteboarding these 5 out and being like, this one's super developed, this one isn't, like, this is where we need to focus, this is what you need. And I think, to your point, we're just seeing an ability to move faster on some of these, but you can't forget the rest.
Right.
And that remains true.
Because if you take this idea that any one person can now go and build a product and deploy a product into the world, well, that's one of those 5 things.
Exactly. But then they don't have customer development. Maybe you need team to support you. Maybe you need to go to market. Maybe you don't. And maybe your team should include agents in this new paradigm, but you'll still need those workflows to get done.
What would your piece of advice be to somebody in a world where anyone can build a good piece of technology?
Yeah, I mean, I think at the beginning of the journey, you need to just think about the customer. You need to think about solving a problem, because at the end of the day, no one's going to use something they don't want or they don't need. And behavior change and change is hard. And so unless you find a way to secretly get into the workflow and still secretly get paid by your customers, which I think is sort of an impossible feat.
Sure.
You're going to need some sort of adoption.
So one of the things that I have said to people before is calling yourself an AI business now is kind of like calling yourself an email business 10 years ago. Like, I hope you're using modern technology to do what you're doing, but that's not why I'm buying whatever you're selling. And I think, and this is, I think, been pushed a lot by the VC narrative. VC's obviously so excited about AI, and you'd be crazy not to use AI in the way that you build your company. So people want to put it front and center. But the reality is it is another tool that does various things. And when people are coming into building a new product or building a new business and thinking about their customer, does a product come later in that process then?
Yeah. So, I mean, I think I'd separate out the market into what I'd consider sort of like technology-led opportunities, where maybe it's pre-product, pre-commercialization, and businesses that are post-commercialization, sort of post-product. And, for instance, in the world of drug discovery, you might not actually know exactly what the efficacy is going to be, how something could be used, but there's still very much a market, and there should be a market for investing in that. That's different, I think, than what we're talking about here. Yeah. I think going after a big market, going after a market that has decent unit economics, like, that doesn't change. And AI doesn't change that one way or the other. Ultimately, it's about having a scalable model, having a sticky model, having a way to evidence value to your customers that they're willing to pay for over and over again.
I guess the other piece there is around trust and authority and how you actually gain those customers. And I think what I'm kind of chivvying us along to, which is my own agenda, is that the role of domain expertise, or what actually I'm now more broadly called context and content, context being relationships, business logic, understanding of a piece of infrastructure and that infrastructure itself, and content being the derivatives of that, i.e. a history of trading. That the value of those things and existing relationships are more important in particularly your first customers than your ability to build a good product, because there's an assumption now that you probably can build a good product. What do you think that means? Like, do you think that the role of domain expertise and relationships has changed, and what does that look like?
So I think there's actually some pretty good synergies between what you've been doing at Tramlines and how we think about things at HSBC Innovation Banking. And what I mean by that is we've done a bunch of work that looks at what we're calling founder factories. So there's a number of companies in this country, but you can see this around the world, where they've had great exits. Deliveroo is one, but you can think about DeepMind, you can think about Arm, that all have created the next generation of talent that's leading the next generation of company. Now, that domain expertise could be around a specific problem, could be around technology, or it could just be they know how to build and scale a company. That alone, the number of conversations, both with investors and founders that I have around like, hey, do you know a great CFO? Do you know a great marketing person who's done this either 0 to 1 or 1 to 100? That's a huge part of the domain expertise. And we see an acceleration of that activity from these founder factories, but two, we see that people who have done this before are able to raise more money at higher valuations. So there is a real premium placed on expertise that we see in the market. And the fact that we're seeing more and more of that in the UK, and every time we have, a Colt or a Thoroughbred or a company that's able to have real results, have people leave and then go create their own companies, that will only accelerate what we're seeing.
So that's really interesting. So I have a kind of natural disdain for what you've just said. Despite annoyingly agreeing with almost all of it in exactly where you said it, which is that, I talk a lot about the role of domain expertise being non-founder domain expertise, i.e. people who have industrial experience or industry experience of solving problems, of building relationships. And in a world where barriers to building technology are so low, the thing that is really valuable is an existing understanding of the problems, ultimately, the customers, to your point, of what problems they have and how you can get close to them. Now, I've also been historically quite critical of VC, not because it isn't a great tool, but because it is a tool that has a disproportionately large amount of media and therefore is often presented, I think, to people for whom it might not be the best route, or perhaps is inaccessible. But one of the things I think is interesting is, in the UK, what I have noticed, and I guess I'm in this category as an exited founder, is that there is a more mature group of exited founders or people who have done that growth journey who are more relevant to VC. But I'd be interested to ask you, I don't focus on those people. In fact, I say to those people, if you can go and build a business with venture capital, go and do that and don't work with tramlines. I'm really focused on the domain expert who in the UK historically might have more likely started a consultancy. I think we have a big services industry and very knowledgeable group of people who are very well educated, whose risk appetite might more naturally align them to go and starting a consultancy. And I think the opportunity for scalability there is quite big. So if we think about them both as quite different domain experts, how do you see the relationship between them and what can they take advantage of?
Yeah. So I think I can bridge the two of us.
Okay.
But let's...
You don't have to. We can also just agree and smash the train set. That works too.
Yeah. No, but if I've understood your business model, that's what you're doing at Tramlines. You're saying come with the non-founder domain expertise and we'll bring that.
Yeah.
And put the two together.
Right.
So I think you are saying that it's super important. It makes the company more investable, more likely to succeed. It's just the two, not one of the two.
Correct, yeah.
And so I think... To me, I think it's really more about, how do we create a flywheel where one success breeds 2 successes, builds 3 successes, builds 4, versus one alone. And to me, that's what's super important and exciting about this market now. So the fact that there are, to your point, like everyone at Tramlines is a repeat founder, someone who's seen what success looks like. There is a pattern to success. It's very easy to look at the VC market and just think like there's one part luck, one part magic here.
Yeah.
But the reality is, and you can see it through founders who have either had repeat successes and or investors who have outsized returns, there are patterns. And the fact that there are patterns means that this becomes investable, that this becomes repeatable, and that you can do it over and over again.
An ongoing joke at Tramlines is that from the early days of particularly the fundraising piece, because that's the piece that seems so different and unclear to a non-historical founder, people used to joke that I would walk into a room, flash my pearly whites, wave a magic wand, and then £1 million would fall on the table because they're so far away from how that process works and what it looks like. And actually, to your point, it is patterns and understanding them and being able to talk about them with authority. And so the bringing together of that kind of industry domain expertise with founder domain expertise is where interesting things can be unlocked. I obviously completely agree with that, as it is our model. Where do you think... Coming back to what you said at the very beginning, or rather what I was pushing at underneath the big valuations, what does that look like in the more mid-market? Are different scales of companies falling out of that new dynamic? What does that look like?
Yeah, I mean, I think if we fast forward 10 years, where do I think the world will be? So I think first off, today when we think about returns, and this is true of all investing, but certainly VC investing, we tend to talk about averages. And I think we're going to need to start to talk about, I don't know if it's quite like the mean, the median, the mode, but certainly that top decile and that others, because we're going to see more and more dispersion in returns and some of those outcomes. And so in a world where no one's going to receive the mean, even though it is from an arithmetic standpoint, the mean, how do you think about what those outcomes are? So I think that's one piece of it. But then to your point, there's still going to be great companies that have great returns that are very much appropriately priced from a risk reward that we're also going to need to think about. And the question is sort of what is that mid-market, there's a very deep and strong mid-market private equity opportunity in this country, as well as, sort of developed market. But is there even sort of more breadth, more depth to come there? And I think there probably is when you say, okay, a small portion of companies are going to have really the types of returns that you need for VC over a long time. But then there's also great returning, very strong companies that, will also benefit and be great returners as well. And we're starting to see that. I don't think we've seen that at the scale that we will, but that's coming into the market as well.
So I didn't fully understand the first bit that you said, and I want to pick on it because I think it is alluding to what I'm getting at, which is the two trends that I've seen. One is that traditional venture is very much based on an outlier return model where a disproportionately large number of companies fail completely, as opposed to are moderately successful, because from a returns perspective, the mean is not made out of a few small ones and one big one. It's made out of one big one alone. And so the failures are less important from a returns perspective. So that model I'm seeing being challenged by a more kind of, for want of a less pointed word, sensible approach to the earlier stages of building a business and the earlier unit economics and the creation of cults and thoroughbreds that become unicorns, as opposed to the creation of a unicorn at all costs. And a lot of people talk about this. But the second side of that is what it's also led to me seeing is a segmentation of the venture roadmap in a way that hasn't happened historically. Traditionally, I'm investing in an IPO and 1 in 100 will get there and it'll return what I needed to return. Now I'm seeing big funds set up secondary funds and say, we only do pre-seed to Series A, and then we exit via our secondary fund, or Series A to Series C, and a bit more of a segmentation where there's then more focus on what does a business look like between those different areas. So, I mean, that was very broad and deliberately kind of not too specific, but what else are you seeing and how venture is changing its approach?
Yeah, I mean, I think number of questions embedded in that. So let me take them one at a time. I think I caught I think there's 3 points to lay out. So one is the sort of outlier returns that you talked about in venture, I think is by design. This is a feature, not a bug of venture. And so I don't think that it's a question of challenging venture. That's how venture's meant to work. And that's part of what makes venture so exciting, but also why we've seen outsized returns through long cycles over time. And I think that outlier dispersion is only going to increase. So that's the first thing, which is that sort of the features will just get amplified of venture. And I think that's a positive, good thing. Two is, to your point, both from a maturity standpoint, but also how the market is evolving, we are seeing more and more funds, to your point, either early stage funds becoming multi-strat and bringing in sort of either a scale-up fund or a late stage fund alongside it, leveraging effectively their origination capabilities earlier and or looking at secondary. So that is by far, a trend that we're seeing as well, where investors are becoming more stage agnostic. And in a world in which the size of checks in stages is becoming even more varied, you need to do that as well. So in a world where you can either raise a few $1 million in a seed round, or like we saw in the first half of this year, the first $1 billion plus seed round in the UK, what does it mean to be a seed investor? Do I have to invest a few $100,000? Do I have to invest a few $100 million? Those types of things challenge certain funds. So I think that maturity of the market that we're seeing through some of these large deals is manifesting in mandates that are changing, but also fund managers, great fund managers saying, I'm going to be where the market is and either be early or late or stage agnostic or those type, or get in secondaries, as you said. So we're seeing much more of that. But to me, again, this is just a signal that the market is maturing. I think that final piece of your question, which is also super interesting, is that if we go back, call it 5 years, when we saw the big shift in the market from growth at any cost to pretty much every great founder having some idea of a path to profitability in whatever defined time horizon works for that founder, that means that certain companies will find their right product market fit and maybe change from a VC type trajectory. And that's a great outcome too. And, in a world where distributions or DPI is low, for funds to have a few, outcomes early that give distributions but don't do that, that's also a very good thing. So to me, these are all just signals that the market is maturing versus a failure of the market in any way. And it's just evolution of the market saying that across sort of time horizons, across return profiles, across distributions, there's a place for capital in every one of them. And it's no longer sort of a step function of like low risk, low return, huge step up, higher risk, higher return. We're getting to a place where there's a linear way to allocate your money.
So on a macro level, that makes sense. And the idea of outlier returns being amplified creates an even bigger exciting need for the kind of top end of traditional venture capital economics, which have a place in the world. The point you made around maturation, does that mean that the venture ecosystem stops being so walled from the rest of the financial world? And so a trend that I've seen massively is if you're looking at mid-market liquidity, you cannot be exiting to a private equity-backed strategic at a venture multiple if you're on your journey to scale. And so, is it possible that the idea of VC, and you made another comment about the size of seeds, if you're involved in a seed round at $1 billion and you're involved in a seed round at 10 million, that is not necessarily the same financial vehicle that would look at those two things. Maybe it is, but what do you think that there'll be a splitting out of venture capital to accompany the fact that there are different types of business building?
Yeah. So, I think at its simplest form, and so what we do at HSBC is we try to make it more likely than not that our clients are successful.
Right.
And if I think
That's a
about
lovely thing to do, by the way.
but if you think about the fund side of our business, so we work with technology companies, life sciences companies, and then funds. For a fund, the simplest way that I think about sort of what makes them successful is 1, raising money.
Yep.
2, investing in companies at a reasonable price. And then 3, subsequently exiting those companies at a reasonable price, which is higher than where they got in.
Right.
And yes, there's lots of other things. And, my investor clients are very smart and they've got very complicated jobs. And I feel like I've just dumbed it down to 3 things. I don't mean that, but it's those 3 moments that really matter in the importance of a fund.
Yep.
And on that basis, we can say that for funds, for them to be able to more flexibly invest, but then importantly, that exit piece that we haven't talked about is super important. We've talked a little bit about fundraising. We've talked a little bit about investing that first time. What about those exits? Because you need that third piece, those exits, to make sense, to be at the right value, at the right time frame, and with the right cap structure along the way. And what we've seen, particularly in the UK, and we've just put out some research on this, is yes, exits have been constrained in public markets. We've seen many more private equity to private equity exits, and strategic exits have a lower valuation on average, not a shock, than private equity exits. And so the question is, how do fund managers, how do investors navigate those dynamics? And I think, it really comes down to what is the mandate of the fund, what's the vintage of the fund, those types of things to come up with the right answer. But there's a huge amount of capital both to be deployed through dry powder, as well as that's already been deployed that's waiting for some sort of liquidity event.
On that, one thing, and I think this is my last question on this before I go down a rabbit hole too deeply, but as somebody who's had both bankruptcies and exits, it was very apparent to me that on the precipice of bankruptcy, my VC had no interest in helping me because I was kind of done for them from a returns perspective. And I understood that was okay. That was the game. But in a world where I could have had a more meaningful earlier exit, and that would have mean changing the multiples and restructuring it, how do you think funds will approach that disparity?
Yeah. So I'm going to answer your question in a slightly different way.
Fine.
But then hold me to it. So I think first and foremost, figuring out the right investors on your cap table is one of the most important things that a founder needs to do. And it doesn't just mean sort of who's the logo on their business card. It means who's the human that's going to be with you through the ups and, to your point, the downs. And you want to work with someone who's done that, and has that track record. To your point before as well, on people thinking that you would rain down checks of $1 million or, whatever it was sort of served to you on a plate. When you're a founder looking for investment, chances are you are at a major asymmetric disadvantage to that investor. And what I mean by that is this might be your first company, your second company, your third company. Let's say it's your third company or your second company. You've raised money a few times. Let's say you've done that 10 times, which would be a lot, but that investor has probably seen hundreds, if not thousands of term sheets. Yeah. So you're going to be working with someone who's seen the thing many, many times before, which is an expertise that you want. It's sort of like going to your doctor. You want to go to your doctor and have a doctor who says, I've seen this thousands of times. You want that. But in that moment of negotiation, you're in a tough place. So I think first and foremost, for any founder, picking the right investors is hugely important. When we think about it as a bank, because one of the things that we do is that we lend, and this might sound crazy to folks who are less familiar with the venture market, we lend to companies that are cash burning. And so, how do we do that? A huge part of that is thinking about who are the investors that have invested in the company and will they stick with us through good times and bad? And oftentimes we're looking to get repaid, not through the profitability of the company, but through the company being able to raise again, which is often in large part driven by sort of the investors that sit around that table. And so I think just back to your question, there will be some investors who want liquidity early, some investors who want liquidity late. How do you balance those two? You might have some permanent capital types of investors. You have some that will have different incentives. And so I think just understanding that as a founder is super important. When you bring someone into your business, are they solving for the same things as you? And if they're not, which could be great, because sometimes you can say, you're optimizing for this, I'm optimizing for something else. Together, we both make our pies bigger. That's amazing. But you need to make sure you get the right tension in that.
What I'm hearing, and hopefully what I am seeing, why I'm doing what I'm doing, is a lot around creating more types of investor, I guess, that are looking for different types of return. And that's definitely a trend I've seen massively change. And you're talking about multi-strategy investors, but people are creating what to them is quite novel vehicles because of the opportunities that present themselves. So would you think it'd be fair to say there is going to be a proliferation of what types of venture capital are available and therefore what the return profiles of and therefore what the behaviors are? And what do you think are areas where, or have you seen any new venture models pop up that you think are really interesting?
Yes. I think there's a number of places where I think there's a huge amount of innovation to come, let's say. So first and foremost is, in this country, there's much lower allocation to private capital via pensions than in other countries. And so one part of it is just who is investing. It's not necessarily new instruments. It's not necessarily new ways of doing it. But, do I think that more asset owners in this country will start to invest in private markets and notably in venture capital? I believe they will. And so that is one change that will alter the overall spirit of the market, but I think also grow it. Two is that debt is used far less in the UK and Europe in venture than it is in the States. It's anywhere between 10 and 15% less of the funding than you see elsewhere. So one part is sort of funds that do that, but two is how companies fund themselves as well. So to make sure the companies don't take too much equity, you and I were talking before about companies that sort of maybe don't price their equity the right way. I think there'll be more precision brought to that as more debt comes into this market and as it matures. I think beyond that, to your point you mentioned before, secondaries, the idea of liquidity, that's changing. And this is true of a number of different illiquid investments, but will there be places for liquidity over time? I think that's developing. It's still super early days. We're seeing some of that through a number of private market initiatives and things like that, but that to me will also come in as well. So it's a question of liquidity at the right price at a given point in time.
And so coming back to something we were talking about before we started around the pricing of companies, and you mentioned it again there around pricing your equity right and the role of debt and the roles of different types of debt as well. Mm-hmm. Where are you seeing exciting undervalued companies in the economy?
So I think it's less about sort of specifically undervalued individual companies or not. I think in a market where there's thousands of private companies that have been owned for, thousands of private companies, there will be I don't know if it's a normal distribution or something like that of how people price them.
Right.
And so with the right sort of work, you can find companies that are overvalued, undervalued, precisely valued. To me, it's that is one part of it, but I think it's that capital has not necessarily come to certain areas of the market. So I think there's a number of, I mentioned deep tech before, that's attracted a lot of money, but sort of getting from grant money to actual contracts. And so as we try to create the right pathways for that through either government procurement or otherwise, it says this is how you go from grants to actual contracts and revenues, that will create an ability to fund those companies that hasn't been there before, funded through equity, I should say. So that's one big part. And then I think there's a number of great companies in this market where they maybe haven't attracted capital that they could get capital, particularly growth equity. That's another place to look as well.
And something that I'm very bullish on is the idea that particularly services businesses at the moment in the UK are not necessarily, to your point, undervalued, but that there is a real growth opportunity that hasn't existed in the same way before. I am particularly interested in looking at those opportunities where they've not ever attracted traditional growth equity. They've never attracted VC for sure. They may have taken some level of debt, small business loans, but usually not at any sort of serious scale. And they also generally can't access the kinds of transformative talent that would be required to take them on that growth journey. And there is clearly an opportunity, or at least a perceived opportunity, I'm perceiving it, to buy into and to grow those businesses, be them services or products is actually slightly irrelevant, but businesses that didn't traditionally access it. And what vehicles do you think will take most advantage of that? And where do you think are exciting opportunities you're looking at?
Yeah, I mean, so you and I have talked about it a fair bit. Like what Tramlines does is not a model that, is super prevalent in the market. And so I think that's great, but I think it also speaks to that need that we're talking about. If I go back to sort of my 5 areas of development before, there will be companies that have great sort of product, but they have not done the customer development. They haven't done the business model, which to your point gets to the sort of unit economics, and that creates another vector of growth. But so I think just because a company is doing well doesn't mean it can't do better. And just because a company isn't doing well doesn't mean you sort of can't get there.
And do you think, coming back to AI, do you think AI has the ability to unlock growth in companies that previously could not have existed?
What I think one of the greatest things about AI is it gives us as individuals, but also companies, an ability to focus just on those things that we do super well. And, I can think about it as an individual. What are the things that I'm good at and I enjoy? And then the things that I'm neither good at nor enjoy, or just one of the two, I can probably find an agent or find a software solution or something else to do that for me. Right. I think AI has the same potential for companies. And so to your point before, finding great companies that have good product market fit, they're good at something that they do, for all the other things that company does, and think about many, many workflows, they can use a number of solutions today probably to do those for it. So the company can focus on what it's good at, and the founder can focus on what it's good at. I mean, certainly given what we do, I talk to a lot of founders and a lot of investors about how, ideally the CEO of a company is not spending tons of time opening up bank accounts.
Right.
It would be great to work with someone like us where we can make it easy and we know what they do, because that's not a high leverage use of that CEO's time.
Sure.
I think the same thing is true of AI, and it's just changed the fact that, for founders and for teams, focus on the things that you're really good at. And then for everything else, partner, use a vendor, develop your own agents, do those things, but then just focus maniacally on what you're good at. And I think AI has changed that calculus of what a company needs to do itself.
I love the idea of anyone focusing maniacally on anything. But there's one other point that pops out for me of this AI piece, which is around, coming back to the unit economics thing, so the historical venture capital model has focused, particularly in B2B software, disproportionately on the SaaS model. Build one thing that can be adopted by as many people as humanly possible at amazing unit economics, and you'll build an amazing high multiple business, and that's the venture dream. But in a world where a single human being, potentially, and I'm not saying it's been necessarily realized, can have this multiplying effect via AI, suddenly the unit economics of human labor can become venture exciting. And that creates potentially a whole new class of business. Now, that's something I'm really interested and focused on. What does that mean to you? Do you agree that there's a possibility of services-based businesses with venture-style economics, and how does that change what kinds of businesses are backable in venture and buildable in that scale?
I think I think part of what you said remains true, and part of it is what's super different and what is so exciting. So I think part of what stays true, and you mentioned sort of SaaS businesses, the idea that you build something once and you can deploy it many, many times across many customers at near virtual zero marginal cost, right? Like that's the dream. What used to be true, particularly before where we are today in the world of AI, is that you had to build a product that sort of worked for everyone as it was out of the box. What we're able to do with AI is that there's able for personalization, for customization, for integration and workflows, so that you can still get near marginal zero cost, but actually deploy something that's different for different users, for instance, if you look in the consumer tech space. And so I think that premise of the idea of getting that scalability in your time or zero marginal cost to be able to still sell more, that will hold true forever.
Yeah.
It's just how it manifests is totally different. Or if we go back, 15 years and we say, it used to be a case in point where let's say that you and I started some sort of consumer app together, and we would have two teams, right?
Ready, by the way, anytime call me and I'm in.
Well, okay. But like back then we would have started a consumer app and we'd be like, okay, we need like a Android team and we need an iOS team. That's crazy, right? And because what you want to do is have build once and deploy twice. But imagine this not in two sort of operating systems, but you can do it to user needs in different ways. That's what the promise of AI is. But you still go back to the idea that you want to have near zero marginal cost for your marginal customer.
To come to an end, as an investor, as a founder, where would you be focusing your time?
Yeah, I mean, I think going back to sort of my investor comments of like, what are those sort of three critical moments? It's raising capital, it's finding great companies, and it's exiting great companies. Depending on what stage of investor you are, like you will end the type of platform that you sit on, the mix of those three will be very different based on who you are. I mean, last week I was talking to a pre-seed investor in the States because of the nature of what he does. He spends pretty much all of his time just on raising capital and investing because ultimately as a pre-seed investor, he never takes control investments. He never he rarely picks up fiduciary responsibilities. So when it comes to exits, he is passive in that. And for him, as an example, and going back to some of the AI discussions, he is using AI tooling to effectively make sure he can maximize his time just on finding more and more great companies and do none of the other things. And so all the administrative tasks, everything else that he was doing, how does he focus his time on the single highest leverage thing that he can do sort of in your sort of Tramlines way, sort of like what is his superpower of expertise? And then only spend his time on that and then use tooling for everything else. But conversely, if you're a secondaries fund, it's also about sort of working not just on the investment, but also on the exits over time. And so I think it depends on where you are, but those are the three sort of moments that matter that create the outcomes. If you're a company, it's really about, to me, it's raising money, but ideally spending the least amount of time raising money so you can spend most of your time developing your business and your product, and importantly, your customer relationships.
So I want to push way harder on the investor advice, and I want to go earlier in order to get, the space that I play in particularly. As an early stage investor, would you be looking for types of businesses that haven't existed before? Would towards the whole idea of a services business, but what do you think are the things that I'd be focusing on or reading about or learning about as an early stage investor, and where do you think that things are changing fastest perhaps?
Yeah, I mean, I think what's not changing is that early stage investing really comes down to people. And when you haven't, there's so many things that are unknowable. If you're an early stage investor, you're ultimately backing the ability of that individual or that group of individuals to take in imperfect information and then figure out what to do with it, and to constantly change around execution and be great at executing. So that doesn't change. And so I think, finding the right people to invest in, and then importantly for companies, what I said before, finding the right investors to work with you, that's super important. That doesn't change. And I think that's here overall. But I think it goes back to, finding a market that's got enduring, if you're doing sort of post-product, looking for something that's got enduring value to customers, and where there's real ability to scale what that is.
I remember that you told me in your previous role, you were so impatient and frustrated to find companies that were worthy of investment that you more than once had to build a company that was worthy of investment. I sense a lot of similar frustrations in investors today, perhaps not as executionally brilliant as you, that they're able to then go and build what they're looking for. But where do you think that there's a lack of maturity that people can be maybe over-investing in or looking at to help change that if they are not, of your ilk?
Well, first of all, thank you for the compliments. But, I think it goes back to finding a big problem, right? And we know that there's a lot of problems. We've talked previously, for instance, around things like proxy voting or, friction in parts of the market that are very hard. If you find someone who knows a ton about that topic and is a bit agnostic to the solution, but obsesses about the problem, that's something that I did before, which obviously speaks to what you're talking about now.
And then from a founder's perspective, we've talked about a few different types of founders. And I think it's really interesting to talk about the fact that there are different types of founders. And this, what you called founder factory, i.e. the proliferation of founder types because they've been dragged on a founder journey. I love that as a concept. And I
wouldn't say dragged. I'd say they sort of
Sorry.
rode in the same direction.
Yeah. That's very fair. Although anyone who's actually operated inside of a startup knows that it's a stressful and intense experience in lots of very positive ways. And we've also talked about this idea of a domain expert who's the opposite kind of domain expert, someone who's like a real industry domain expertise, but has never had that founder experience. And so how do I decide which camp I'm in, I guess, in a way? Because we've talked about people looking for massive problems, but what you just described is somebody's obsessive about a problem. And I know loads of people like that, but that needs to be attached with somebody who's obsessed with solving a problem. And that dynamic of founder, which I guess is not a new thing, how do you see that becoming a reality? And what would your advice be to founders looking for their partner?
Yeah. So, I mean, I think the advice I would give is the same that I take for myself. And I'm not a founder. I run a company of a few hundred people. Is it, you need to just know really well what you're good at and what you're not. And then surrounding yourself with people who are not only good at the things that you're not good at, but also importantly enjoy things that maybe you don't enjoy. So you can focus your time on things that bring you joy or super high leverage. But, in a world in which we spend more time generally with people we work with that we're awake than, many of our closest friends, you need to really love what you do. And for me, like a multiplier to loving what I do is making sure I'm focusing on the best parts of my job and not the rest. And I think the same is true as if you're a founder.
What do you think that means for equity? So there's been an old kind of, people have said this continuously, and this has been a big challenge of tramlines. Will tramlines companies be able to raise money in the future where tramlines is a significant stakeholder because it's bringing some of this founder expertise? But what I've seen is a lot more companies with a lot more disparate cap tables because there's a lot more people involved with expertise. And there's been a bit of a move away, at least in what I've seen, from the single founder with 80%, 90%. Are you also seeing that change? Do you think it's a good thing? Do you think it's a challenge to raising money?
I think at the end of the day, you need the senior operating team to be incentivized.
Yeah.
And you need them to have aligned incentives with the investors. And so if you have a cap table where the founding team is taking a lot of risk, but that sort of doesn't come through in the cap table. And what I mean by that is they don't have a ton of equity. They don't have skin in the game. That's a problem. And so I think you just need to figure out sort of at what stage of the company does the cap table reflect that? And is there the right incentivization for the founding team as well as sort of key members of management? And so that's critically important. I think that is there. I think the other piece is, as companies tend to stay private for longer, creating secondary opportunities and liquidity events for early employees is also super important. And I'm very happy about seeing some of the liquidity events that we're seeing in this market here around where there's maybe a primary deal alongside some secondary that's allowing early employees to have those great outcomes. But importantly as well, it cleans up the cap table in some of these places.
Yeah, that makes a lot of sense. I mean, talking about secondary liquidity for senior teams / employees more broadly has definitely been a big and quite new conversation that people take very seriously. So as a final question then, coming back to this advice piece for investors and founders, I'm not going to ask you what you do with £100 million, so I'm not sure you'd be able to tell me. But if I asked you to put £1 on a game that you were going to play next, where would you be putting, where are you most interested in watching what will happen in the next year?
So if it's just in the next year, I would put £1 on investing in the UK outside of London. I would do that.
I love that.
One part because of what we've seen. So it's, if I look in the last year, roughly 40% of new venture capital deals by number, not by value, were outside of London. Two is, my career has been more London-centric than not. So it would be a forcing mechanism for me personally to make sure that I'm focused outside of London, like much more. But then I think the third part is that, we see a number of structural forces, be they in sort of the political regime or more around where universities are or those types of things that will make, I think, outside of London even more important to what we're seeing succeed. And so, yes, we're sitting sort of in the center of London right now, but it would be looking outside of London and, places like Scotland, places like Wales, and obviously the Oxford-Cambridge corridor, but, more broadly in the UK.
Interesting. We've had a bit of a struggle around it because we now have a lot more regional founders, which means we see them in person a lot less, which I found a really interesting dynamic to navigate. But that's absolutely amazing. Thank you so much for coming on. It's always such a pleasure to talk to you. We didn't actually talk about trains, wine, or food, so we'll have to do a second episode just on that.
Count me in.
Thank you very much for coming in. It's a pleasure to have you.
Thank you for having me.
Next week, I'm going to be talking to Glenn Robinson, the ex-National Technology Officer for Microsoft, one of the first 4 employees at AWS Europe, and someone who's been at the forefront of technological innovation and transformation for over 2 decades. He is now the Managing Director of the Center for Value Creation, the AI department inside Tramlines, leading technology, innovation, and transformation across our divisions. I am incredibly excited to dig into not only how technology is changing, but also how the economics and businesses are changing around that technology. I think it'll be a particularly insightful episode into thinking about how operators and leaders can start making decisions about how they engage with AI and the future.